Imagine it's 26th March 2013. You are a 56-year-old print shop owner living in Nicosia, Cyprus. Your name is Marios Karalambos, and every morning you unlock a small shop that smells of ink, glue, and warm paper. You print menus, school notices, funeral cards, and invoices for people you know by face and voice. The money for payroll, rent, and your next paper order sits in the bank, where sensible people are told money belongs. Outside, families gather in the spring sun, flags wave for Greek Independence Day, and coffee cups tap against saucers. It feels like an ordinary Tuesday in a country that was told the euro made it safe. If you have ever wondered why a financial system can look calm right up until the moment ordinary people lose control of their own money, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before in rich countries and poor ones, in democracies and dictatorships, in places with different flags but the same hidden weakness. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the doors stay shut. Cyprus's banks, already closed for days, will remain closed again to stop a run on deposits. The state prepares capital controls. Deposits above 100,000 euros will be frozen and used to rescue broken banks. Men like Marios, who spent their lives believing a bank account was a container for savings, wake up to find that a bank account is really a contract, and contracts can be rewritten when the floor starts to give way. That is what this video is about. Not a prediction, not panic, an autopsy of history, because financial systems rarely die like a building hit by lightning. They die more like a bridge in slow motion, with bolts loosening one by one while the traffic keeps moving. And the 6 signs are usually quiet. Money starts leaving the edges. Cash gets harder to reach. Emergency rules spread. Safe deposits stop feeling fully safe. Official prices drift away from real life, and the burden slides downhill onto people with the least power to avoid it. Before we go further, there is something important to understand. A financial system is not a vault. It is a promise machine. Your deposit is the bank's promise to give you money on demand. The bank's loan book is a promise that other people will repay later. Government bonds are promises from the state. Pension funds are promises about the future. Insurance policies are promises about bad days that have not happened yet. On good days, all of this feels solid. On bad days, you discover that the system is built less like a castle and more like a frozen lake. It holds as long as enough people trust the ice. That is the core mechanism behind almost every quiet crack in financial history. The system borrows short and lends long. In plain English, it takes money that people may want back today and turns it into assets that may only pay off years from now. At the same time, governments pile debt on top of debt, and banks use yesterday's asset prices to justify today's confidence. When growth slows, when interest rates jump, when a currency peg breaks, or when depositors start to doubt, the promises stop lining up. The left hand says the money is available now. The right hand says the money is tied up elsewhere. The gap between those two hands is where panic lives. This is why collapse so often arrives disguised as protection. A withdrawal limit is introduced to save the banks. A capital control is sold as temporary. A bailout is described as stability. A guarantee is announced to calm markets. Each measure is presented like a sandbag against a flood. But the sandbags themselves tell you the river is rising. Once you understand that, history starts to look less like random disasters and more like the same storm wearing different clothes. The first sign is quiet deposit flight, not the dramatic scene with crowds screaming outside a bank. That comes later. The first sign is quieter than that. People who understand the risk begin leaving early, before the headlines, before the speeches, before the rules change. The place to see this clearly is Argentina. By late 2001, Argentina had been in recession for nearly 3 years. Its peso was fixed by law at $1. For a while, that felt stable. Then it became a trap. The fixed exchange rate made Argentine exports less competitive. Debt kept growing, and the country lost room to adjust. It was like bolting the steering wheel straight on a mountain road and calling that discipline. Businesses and wealthy depositors started moving money abroad. Ordinary people noticed the smell of smoke only after the people in the front rows were already heading for the exits. To their own savings, ATMs were vandalized, supermarkets were looted. President Fernando de la Rua resigned on 20th December 2001 after violent unrest, and the temporary enclosure became something worse. Dollar deposits were the system. That is the first sign the financial system is quietly cracking. The people closest to the plumbing begin pulling money out before the public understands why. By the time withdrawal limits arrive, the crack is already in the beam. There is another reason Argentina belongs in this story. It reveals how a financial crack stops being financial and becomes cultural. In Buenos Aires, the middle class had not thought of itself as revolutionary, and the memory lasted. Nearly 2 decades later, Reuters reported that the ghosts of the Corralito still pushed Argentines to stash cash at home rather than trust banks fully. That detail is easy to miss, but it matters. A crisis does not end when the branches reopen. It ends, if it ends at all, when people stop organizing their lives around what happened to them. In this sense, financial crises leave ruins you cannot photograph. The broken building is invisible. It sits in habits, in family warnings, in the envelope of dollars hidden in a kitchen drawer. That is why the first sign is so dangerous. By the time ordinary people notice that confidence has become a private matter, the public system is already weaker than it looks. The bank may still have a logo. The minister may still have a microphone. But the trust that once connected one citizen to another has started dissolving like salt in water. And once that shared trust goes, every next measure becomes easier to justify. Here is something I want you to think about before we go further. If your bank told you that your money was safe, but you could only take out 60 euros a day, would you still call that safety? Drop your answer in the comments. Seriously, because what I am about to show you next is the part of this story that most people never hear. And it changes everything. Its economy had already lost roughly a quarter of its output compared with before the crisis. So when the 60 euro limit arrived in 2015, it did not strike a healthy society. It struck a body already losing blood. Now here is where it gets interesting. The second sign is not just that cash gets rationed. It is that emergency measures stay longer than anyone expects. In Greece, controls first imposed in the summer of 2015 were only fully lifted in October 2018. More than 3 years. That is one of the most important and least discussed lessons in financial history. Temporary measures have a habit of becoming long weather. A week becomes a month becomes a year. The public is told the bridge is closed for repairs and quietly learns the bridge itself was the problem. The deeper mechanism was simple. Greek banks had suffered from years of recession, bad loans, and deposit flight. Once enough depositors feared they might lose access, they acted in ways that made loss of access more likely. That is the cruel loop at the center of banking crises. Fear changes behavior. Behavior changes reality. Reality then justifies the fear. It is a trap that closes like a fist. And there was something else. The Greek case showed that membership in a major currency union did not remove the ancient risk of financial confinement. Many people assumed the euro was a steel wall. In practice, it was more like a painted door. It looked reassuring until the lock turned from the other side. That is the second sign. The system begins choosing its own survival over your flexibility, and it calls that necessity. The third sign is even more unsettling. The definition of what is safe starts to change, not in theory, in law. In March 2013, Cyprus set the template that later terrified savers across Europe. Under its bailout deal, Laiki Bank was wound down. Deposits under 100,000 euros were protected. Deposits above that line were frozen and used in the rescue. At Bank of Cyprus, 47.5% of uninsured deposits were converted into shares, which means part of a saver's cash was turned into ownership in the damaged bank itself. Reuters reported that the conversion amounted to about 8 billion euros in depositors' cash. At Laiki alone, about 3.4 billion euros in deposits were wiped out. Now look at the psychology of that moment. Most people think of a bank deposit as private property stored in a safe place. Cyprus reminded the world that in a crisis, a deposit can be treated more like fuel for the rescue itself. The state did not arrive with armored trucks full of money to fill the hole. It reached into the balance sheet and told depositors that the hole was partly theirs. That is what a bail-in means. The rescue comes from inside the wreckage. Return to Marios Charalambos in Nicosia. Reuters quoted him that day saying he felt humiliated and worried about what would happen when the banks reopened. That word matters. Humiliated, not merely anxious. Humiliation is what people feel when the rules they trusted are not just broken, but reversed. The bank account that once signaled prudence now marks you as trapped. The careful saver becomes the easy target. The prudent are milked because the prudent stayed put. The counterintuitive fact is that this can happen in a modern, euro-using country with deposit insurance rules, lawyers, central bankers, and all the ceremonial language of stability. Crises do not wait for primitive institutions. They happen inside polished systems. The marble lobby is not the same thing as safety. Sometimes it is just better lighting. This leads to the fourth sign. The official story begins to drift away from lived reality. Leaders say controls will be temporary. Banks say confidence will return. The public hears the words, but daily life says otherwise. In Cyprus, banks stayed closed to prevent a run. ATM withdrawals at the two biggest banks were capped at 100 euros a day. Capital controls arrived inside a currency union that was supposed to guarantee free movement of money. The gap between the slogan and the street widened. And once that gap opens, trust does not break all at once. It frays like old rope. strand by strand. Think about what that means for a small business owner. Payroll does not become temporary because a minister says the controls are temporary. Rent does not pause because Brussels issues a statement. Paper suppliers do not ship on optimism. The official language of crisis is almost always abstract, but the daily experience is painfully concrete. It is the daughter asking if university fees can still be paid. It is the employer counting the notes in a till. It is the pharmacist deciding which invoices to delay. A financial system under strain does not first fail in the Treasury building. It first fails in timing. Bills come due on one clock. The rescue arrives on another. Cyprus also exposed a truth that many savers had never really faced. Deposit insurance does not mean every euro in every account is untouchable. It means there's a line. Below that line, one set of promises applies. Above it, another world begins. For years, that distinction felt technical, almost boring. Then in 2013, it became the border between sleep and panic. A company with 90,000 euros could breathe. A company with 190,000 euros could be thrown into a completely different reality. The same bank, the same branch. A different fate because of a legal threshold most people had barely thought about. And notice the precedent this set. During the global financial crisis of 2008 and 2009, many banks had been rescued with public money. Cyprus told Europe that the next rescue might come from depositors instead. That was a profound shift. It moved the burden from the taxpayer in general to the trapped saver in particular. It also changed the way people everywhere had to think about bank balances. A deposit was no longer just savings. In a bad enough crisis, it could become involuntary capital. This is why these episodes matter far beyond their own borders. Greece showed how quickly a modern banking system could ration daily life. Cyprus showed that even inside the euro, ownership itself could be redefined under pressure. Argentina had already shown how a temporary cash limit could turn into a deeper social rupture. Put together, they form a map, not of one country's mistakes, but of the pressure points hidden inside the system itself. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you're still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now look at all three together. Argentina in 2001, Greece in 2015, Cyprus in 2013, different countries, different decades, same result. First, money moves quietly before the crowd sees the danger. Second, cash access gets rationed because the system cannot survive a full test of confidence. Third, emergency rules linger. Fourth, supposedly safe claims on the system get redefined under pressure. The same mechanism, different countries, different decades, same result. What ties them together is not culture. It is not morality. It is not whether a nation is Latin American or European, rich or poor, left-wing or right-wing. It is the same old timing problem. Money that people may want back today has been tied to loans, bonds, and promises that only work if nobody asks for too much at once. Once enough people want certainty at the same time, the system reveals its true shape. It was never a giant vault. It was a chain of promises balanced on motion. A bicycle stays upright while moving. Slow it enough, and gravity takes over. And there's another pattern hiding in plain sight. The measures used to save the system are often the same measures that teach the public never to trust it the same way again. Argentina's Corralito left a deep memory that Reuters said still pushed people to stash cash at home years later. Greece's temporary controls lasted more than 3 years. Cyprus created what Reuters called a European template for future bank rescues. The rescue succeeds in the narrow sense if the banks reopen. But something deeper breaks. Citizens stop believing the system is neutral. They start believing it has classes of passengers, and they are not in first class. At this point, the pattern becomes impossible to ignore. Financial cracking is not always visible in a stock chart. Sometimes it appears first in behavior. People want dollars, not local currency. They want Treasury-backed money market funds, not bank deposits. They want tangible assets, not paper promises. In March 2023, after the failures of Silicon Valley Bank and Signature Bank, Reuters reported that deposits had started moving out of U.S. banks and into money market funds as investors sought safety in Treasury securities. That did not mean America was repeating Argentina or Cyprus. It meant the oldest instinct in finance was still alive. When trust wobbles, money runs downhill toward whatever looks simplest. And this is where history gets uncomfortable. The fifth sign is when official value and real value begin separating. That can happen through inflation, through a collapsing exchange rate, through a black market price for dollars, or through paper balances that cannot actually be used in the same way as cash. Lebanon is one of the clearest modern examples. Lebanon's crisis erupted in late 2019 after years of debt, corruption, slowing capital inflows, and a banking model that depended on confidence staying permanently high. Reuters described a hard currency liquidity crunch that led banks to impose tight curbs on cash withdrawals and transfers abroad. The World Bank later said the crisis was likely to rank in the top 10, possibly the top 3 most severe crises globally since the mid-19th century. Real GDP contracted by 20.3% in 2020 after shrinking 6.7% in 2019. GDP fell from about $55 billion in 2018 to an estimated $33 billion in 2020. Inflation averaged 84.3% in 2020, and more than half the population was likely below the national poverty line. But statistics only tell you the shape of the fire. To feel the heat, look at the people inside it. Reuters reported that more than $100 billion remained trapped in Lebanese banks. Danatrometer, a 48-year-old filmmaker living in Britain, said her mother could not get a penny out of trapped retirement savings to buy everyday essentials. Arif Yassin, head of Lebanon's Engineers Syndicate, fought to recover money tied to health care and pensions for about 100,000 people. Lawyers told Reuters that poorer depositors were being hit hardest. The World Bank called the burden of adjustment highly regressive, which means it fell hardest on those least able to bear it. This is not just a story about bank closures. It is a story about two currencies inside one country. There was the official story, and there was the street story. There was the number written in your bank account, and there was the much lower value you could actually extract. That split is poison. Once a society starts living with one price for paper money and another price for real life, the measuring tape itself bends. Shops cannot plan. Families cannot budget. Salaries become sand. If you want the most extreme version of that split, go back to Weimar Germany in 1923. Before the First World War, the exchange rate had been just over 4 marks to the US dollar. By November 1923, $1 was worth 1 trillion marks. Britannica describes a student ordering a coffee for 5,000 marks, then finding the second cup cost 7,000 before he finished the first. Pensioners starved. Farmers refused to sell for worthless currency. Money did not merely lose value, it lost time. It spoiled in people's hands faster than milk. The sixth sign follows naturally from the fifth. Once the measuring tape bends, the losses are pushed downhill. Not everybody suffers equally. That is one of the hardest truths in all of economic history. Financial breakdown is often sold as a national emergency, but it behaves more like a selective tax. Small savers, wage earners, pensioners, and small business owners tend to pay first. People with political access, offshore options, diversified assets, or debts that can be inflated away often come through better. Look at the United States in 2008. Americans often remember that crisis as a housing crash, and it was. But it was also a crisis of confidence in supposedly safe financial plumbing. On 16th of September 2008, the Reserve Primary Fund, a giant money market fund, broke the buck after losses on Lehman Brothers paper pushed. Its value below $1 per share. Within days, the U.S. Treasury announced a temporary guarantee program for money market funds, backed by up to $50 billion from the Exchange Stabilization Fund, because officials feared confidence was evaporating. Soon after came TARP, the $700 billion rescue program passed in October. Notice how revealing that is. Even in the United States, even at the core of global finance, a product sold to millions as cash-like and safe needed an emergency federal guarantee to stop the panic from spreading. The reassuring label was not enough. The system still depended on belief. And who carried the human cost? The Bureau of Labor. Statistics says U.S. employment fell by 8.6 million jobs during the Great Recession, and more than 15 million people were unemployed at the peak in October 2009. Families lost homes. Retirement accounts shrank. Towns built around construction and credit were hollowed out. Yet large institutions were rescued because they were judged too dangerous to fail. Once again, the floor gave way hardest under people who were not invited into the room where the rescue was designed. So who got hurt most across these episodes? The historical record is brutally consistent. Middle-class savers in Argentina who trusted bank deposits over cash, Greek pensioners who depended on daily access to a modest benefit, Cypriot business owners and depositors whose balances sat above the insurance line, Lebanese workers paid in lira while prices sprinted ahead, German pensioners in Weimar whose fixed incomes were turned into jokes by runaway prices, American workers whose jobs disappeared even when they had never touched a mortgage bond in their lives. The pain spreads outward like cracks in glass, but it begins where people have the least cushioning. The people who walked away relatively fine were not always the smartest in any broad sense. Often they were simply positioned differently. In Weimar, debtors could see their fixed debts evaporate while savers were destroyed. In Argentina, those who moved into dollars early or kept money outside the system had options later. In Lebanon, Reuters reported accusations that elite figures were still transferring money abroad while normal people could not. In the United States, owners of strong assets who could hold on eventually benefited from the recovery, while wage earners without buffers absorbed the shock directly. History does not reward virtue evenly, it rewards structure. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. The historical record shows that those who came through these periods largely shared three characteristics. First, they understood that cash access and long-term health are not the same thing. A bank, a state, or a fund can look fine on paper and still fail the moment too many people want access at once. The survivors respected that difference. They did not confuse an account statement with immediate control. Second, they were alert to rule changes. They noticed when governments started talking about temporary controls, special levies, extraordinary support, or one-time conversions. They understood that language in a crisis is often like wallpaper over damp brick. The words are there to hide the stain. Third, they avoided single points of failure. Again, this is not advice. It is pattern recognition. People who depended on one bank, one paycheck, one currency, or one political promise were often trapped when the trapdoor opened. People with multiple forms of access, multiple sources of income, or assets outside the exact point of failure had more room to breathe. In country after country, the winners were rarely the people chasing the highest yield. They were the people least dependent on one fragile promise. There's also a moral lesson here, and it is not pleasant. Financial systems do not merely distribute money, they distribute time. The powerful usually get more time. They hear the warning earlier. They can move funds faster. They can hire lawyers. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.